Let me tell you about a conversation that happens more than people realize. A client sits down with us and says, I think I'm paying about 1% in fees. And most of the time they believe that because that's what they've been told.
But then when you start digging deeper, the picture changes. There are advisor fees, there are internal fund fees, there are platform fees, so many different options that nobody really knows about. And then that 1% can become 2, 2.25%, 2.5%. If you have a $1.5 million portfolio, that could be in excess of $30,000 a year in fees.
And the scary part, many people have no idea. And that's why today matters and why we're talking about what we call the silent killer.
Welcome back to the On Track Retirement Show that's built to bring clarity and confidence to your retirement plan.
I'm Pat Schmidt.
And I'm Jay Karate.
Oh, we are excited to be back better than ever, Jay Karate. And maybe if you're tuning in for the very first time, let's tell you a little bit about what this podcast is all about. It's about helping folks get on track, stay on track, and have a confident retirement. Not an okay retirement, Jay.
But a confident
retirement, have a great retirement. We got another good one today, don't we?
We do. What we're talking about is what we call the silent killer. Oftentimes when we think about fees in this process, we have an idea, but there's a lot we don't know, and we need to unpack that.
This is something that impacts every single retirement plan.
Every single one.
Yeah. And there's fees, and then there's hidden fees.
Right, and that often creates confusion when we want clarity. It often creates the opportunity for us to bring light to a subject that is often kind of dark, not necessarily maliciously, but not really transparent. And we certainly want to be transparent.
Yeah, so we mentioned the silent killer, hidden fees, not the ones that maybe your financial advisor talks about, but the ones that often go unspoken. That's going to be the focus of today. And here's the problem. We don't necessarily think fees are bad. Fees just create confusion. There's lack of transparency, lack of clarity. And so I think where we need to start and maybe park for a minute is bringing to light where all those fees exist. Because, there are the advisor fees, but then there's the fees that they don't make mention, platform fees and trading cost and management fees and commissions, and the list goes on and on. So let's jump right in, Jay.
Yeah, the first one typically that most people understand is an advisor fee. If you sit down with an advisor and they say, our fee is 1.35% or 1.25 or 1% or whatever that fee structure is, here's how much this is. And that is simply for them. And when we think about that 1%, typically that's a conversation of, well, it's 1%. That means there's 99% that we don't have to worry about. That 1% seems like it's such a small, infinitesimal type of number. However, it's slowly eroding and eating at your retirement fund on a monthly or quarterly basis, however it's paid. So let's just think about that for a minute. If you have 1% of $1 million, that's $10,000 a year. Mm-hmm. Now, nobody's stroking a check for that, but that's real money.
And that's assuming that the portfolio doesn't grow.
Correct.
Right? And so as the portfolio grows, that percentage stays the same, but the dollar amount continues to grow as well. But let's just say it's flat over a 10-year period. If they're paying $10,000 a year, right? Easy math, that's $100,000 over a 10-year period. If the retirement is 25, 30 years, well, you can do the math. That's $250,000, $300,000 over that period of time. That's a heck of a house. I mean, that's a significant payment people are paying over the course of their retirement. And so obviously that can have a drag itself, having that percentage-based fee model, correct?
Correct. And that high advisor fee is something that not only is it expensive, but you have to now ask, what am I getting for this? If the advice that we're getting is, well, buy this mutual fund or buy this stock, and we'll see you in a year and do a review, or there's just carte blanche to go ahead and do certain things, that's where some of these other fees come into it as well. Advice is advice. You often get what you pay for, but we also have to say, what am I paying for and what am I getting? There has to be a real cause and effect here that we look at.
Sure. These percentage models, we're going to call them more the wealth management financial advisor models that folks do, and this is something that we don't do as a retirement advisor firm. We have a different model, and we'll talk to that later on. But as we talk to the percentage-based fee model, I think what's really important to understand is that percentage-based fee model was created late 70s and early 80s. What was also invented about that time?
That's when our employer-sponsored savings, 401k savings.
So you had these plans that were now being invented. And so you had people putting, small chunks each and every year. Maybe it was $6,000 or $7,000 a year. And the advisory platform was charging 1%. Well, it was still significant, but 1% on $6,000 or $7,000 is not that much. I don't believe that the financial industry ever envisioned, maybe they did, that it would ever then start to be to a place where now they can charge a percent based off of six-figure portfolio and seven-figure portfolio. But why have they been able to get away with that? I think the reason is simple. You made mention before, no one's writing a physical check for these financial planning fees. This is all being drafted right out of their account. And yeah, there's visibility to it. There was air quotes there, but it's happening on their statements, right? It's buried in their statements. Page 7, page 27 of their actual statement report.
And when we see these numbers come out, again, if you look at it, I think the most consumers, and I think it's fair to say, they open their statement, they open the email, and they say, okay, last quarter I was here, and this quarter I'm here, so I got to be okay. I'm not sure that there's a lot of thought that goes into what was the percentage, how much could it have grown, but then there's a percentage off for the advisor fee or 1.35 or whatever that fee is. We see the growth, but we don't subtract the expenses and what that looks like. So those are some of the things, as we've identified this as the silent killer, and there are things that we just don't know about. It just is a very, very slow drip. And over time, to your point, those dollars that we look at the end of a 20 or 25 or 30-year retirement is maybe as much as a lot of people's entire retirement could be as well. So if we have that $200,000, $250,000, $300,000 expense, where could those dollars have gone? And how could they have grown for our legacy as well? That's part of it. So as we think about retirement, it's more than just buying more things. It's more than just going and saying, I've got a wealth manager at this fund or at this company or that company. Again, we are a different model intentionally. And part of what we do, if not the basis of why we do this, is to help educate consumers so they understand things that they may not know on the front, but they are able to understand and ask good questions at that time.
Yeah. So I think, if you're out there and maybe you're with an advisor that does the percentage-based fee, or maybe you don't know, I think first and foremost, you need to ask, okay, what is my advisor fee and cost each and every year? Now, be mindful, we'll get part 2 of this, is that's not the only fee that you're paying, but it is important to understand what's that advisory fee. And then the question right behind that is, okay, what am I getting for that fee? And by the way, when you hear 1% or 2%, whatever it might be, that number doesn't sound that loud, right? Where it sounds a lot louder is when you start doing the math, and often people don't, but you start doing the math, okay, that's 1% or 1.35 or 2.2, and it's on this amount, that certainly adds up. So then you have to add, okay, what's the value that I'm getting for this? If somebody is only helping you pick investments, what stocks to own, what mutual funds to own, what investment products, I think that's a little bit of a dinosaur. Today in the technology world, there's a lot of access where people can do those things themselves. Absolutely. To being quite honest. So we'll circle back to maybe some of the do-it-yourselfers because there's people that are going to be asking about that. But I think as we move into the more of the hidden fees here, this is now where there's very, very little transparency are the fees and costs beyond the advisor. Because if you're paying that 1% fee, that's not it, right? There's fees and costs behind that. You may mention a few of those before, Jay. You have, expense ratio. So that's the internal fee for the mutual fund. There's transaction costs, whether that's the buying and the selling. There's commissions, there's platform fees. There's all these different types of things that don't necessarily show up on a statement, right?
Right. So when we opened the show, we talked about if we think it's 1%, but what if it's 2 or 2.25? So what's the difference there? That 1.25 or 1.5% on top of the 1%. So the expense ratio fees or internal fund fees. We know that with mutual funds, they all have a fee. We don't know what they are until we get digging into that. And whether it's electronic or via mail, you'll get a prospectus every single year that's about 97 pages long. And that fee is typically hidden on page 42 of that, likely in 6-point font that's very, very light that we don't really know what that is. It's compliant. It covers what needs to be done, and that's fine. But if we don't know what those numbers are, now all of a sudden, this is really the silent killer that we talk about. What if you are at another 0.75% of that fee and you've got X number of dollars in mutual fund? Well, there's a percentage of that comes out every single quarter on top of it. And again, it comes out of your investment portfolio. You're not writing a check for it.
That's right.
A bit like taxes. If we had to write a check every single paycheck for what we owe the government, there'd be a bit of a revolt. With this as well, we don't know. It just is kind of sucking the life out of it at times, which may not be that big of a deal in the past 12 of the last 14 years when we've had great growth in the market. But what if we have a really down market and we're down 8% and you've got another 2% on top of that? Now you're losing even more money. I think that's when people kind of raise their hand and go, hey, why are we losing so much money? That's part of it.
Well, in the mutual fund industry has gotten massively rich over the last 40, 50 years, right? So when the 401k was birthed, right, what took off right with it was the mutual fund industry, right? Because they have forced Americans, as they put money into their 401k plans, what are the options that they have available?
10, 12, 15 maybe out of 25,000 now?
Yeah, so exclusive mutual funds, right? So they force folks to park money in there, and then there's the mutual fund manager, right, who's getting, fees and cost and those prospectus as you made mention, Jay. Well, I'm sharing that with you because the mutual fund industry is $1 trillion, that was a T, $1 trillion industry. And you think they have a little bit of lobbying power in Washington, D.C. when
one of the biggest.
Yeah, so you have many Americans, hey, we want more transparency. We want more clarity in what we're paying each and every year. And the mutual fund industry is, we're providing that transparency. We're providing that clarity. We send an annual prospectus out to the client each year, which is like this thick, and you have to have a PhD in finance to be able to read and understand. And there's that engineer. I see you out there. He's like, I read those. There's always a few of those out there, but very few people do. But so what is happening here is, let's say that you pick an advisory firm, right? So let's say you're working with a financial advisor. You're paying that advisor a percentage fee. Okay. Right. What is that advisor doing is they're taking your money and now they're putting into a basket of mutual funds. Well, those mutual funds then all have a fee or cost now associated with those. So I hope you can envision the piling of fees that happen. So then it's like, well, what am I paying my advisor for? Because all my advisor is doing is putting me in these 4 or 5 different mutual funds, and then I got to pay those 4 or 5 mutual funds too. So as you made mention before, you can get to 2.5%, 2.25% really quick,
fast.
right? So the mutual funds have a lot of fees and a lot of costs. One of the questions, and we'll be doing some podcasts coming up specifically to annuities. Maybe one of the questions that we get, maybe more than anything, is, what's your take on annuities? Are they good? Are they bad? It seems like it's a real polarizing subject. I feel like there's a lot of really good annuities that are out there, but there's a lot of really bad annuities that are out there, and annuities maybe that have been positioned with folks improperly. But variable annuities specifically have high fees, high costs associated with those, and those are also baked into those. So here's what's important, and I'll kind of piggyback off of maybe what you shared before, Jay, are those fees and costs are always there. Right. And so what are they doing in the good years? So when the market does really well, what are those fees doing? They're just reducing your returns. Do those fees still happen in the bad years?
Still do.
Absolutely. So essentially what they're doing now is amplifying those losses, right? So reduce the returns and amplify the losses. And then they get to do those expensive commercials during the Super Bowl about how we do better when you do better. But they always do pretty well, don't they?
Yeah, they're naming rights. Somebody's got to pay for those. And so when we see names on stadiums at Super Bowls, not only the commercials, but who does that as well? Those are expenses. Where do those dollars come from? They come from the consumer, and the consumer through their mutual funds, for example, using that. That's what generates those dollars. So it is a layering effect that isn't necessarily often talked about in the confines of a financial advisor's office. By the way, here's our fee. Here's a mutual fund fee. Here's any extra fees that you don't even know about. Here's our paper processing fees. All these fees that go into it, and it just causes money to be just out the back door. If we're bringing money in for supplementing our Social Security, supplementing our pensions, and all of a sudden we have all these fees that are just vaporizing. We often say it's going out the back door. When you got money coming in the front door, some of it's going out the back door. We need to close that back door. We need to seal it. We need to put taper on it. We need to do everything we can to keep the leaks out. We wouldn't keep our door open during a cold winter while the heat's on. I was told that I wasn't born in the barn. Excuse me, I wasn't born in the barn, so I got to close the door when I was growing up. We have to close those doors and minimize those fees. Early on, it's a little bit different. When we get to retirement, it is such a profound understanding that again, I don't want to over express it, yet don't want to underplay it either. This is really, really significant.
Yeah, so let's really camp here for a second and talk about why these fees specifically matter for retirees. Yeah, the younger person who's just putting money into their investments, into their 401k, those fees and costs are there. They still matter. They still significantly matter, but they don't matter as much to that person who is near or in retirement. And the reason why is when folks get to retirement, what are they doing? They're starting to live off of those retirement dollars, right? So in your analogy, I love that there. In your analogy, Jay, is you're taking money out of the financial house, right? You're taking money out of the front door to live off of each and every month as the retiree. You need to be mindful as there's money going out the side door, the back door, the garage door, the window, because that's really the fees if you're not aware of that. You ought to run your retirement like you run a business. And that means you need to understand income, but you need to understand where all of those expenses are and being mindful of that.
A bottom line is only important if we have a good top line, but in that top line, we have to figure out what those expenses are in between. I just think that we don't fully understand from a consumer standpoint exactly what that means. So what's that education look like? How do you ask the questions? One of the greatest burdens in life is knowing what we don't know. Mm-hmm. So now we have to ask those questions. We have to ask intelligent questions to get intelligent answers. It's not just, hey, what are my fees? But let's dig in a little bit deeper and ask those questions. We need to figure out a way to bring more clarity to our own plan so that we have the opportunity to share that. One of the things that I think that you mentioned early on in life savings versus retirement and what that looks like. The law of compound interest tells us about time. What does time look like? I have a personal thought that every high school student in America, every high school student in America ought to study the compound interest table to see what that looks like. When we understand time, and when we're 30, 35, 40, 45, even 50 years old, and we have these expenses, we do have the opportunity to recoup some of those over time. As we get to 60, 65, 67, 75, 78 years old, now all of a sudden we're thinking, I don't have time to recoup those. Yeah. And if I'm pulling money out and I'm pulling a percentage out and more dollars are being lost, how do we recoup those, especially not if, but when we're in a downturn economy?
So if you're listening out there, let's give you some action steps here. So what's the right approach? Number one, it's ask better questions. Yeah. The question that you ask your advisor can't be, so what's your fees? Instead replace that with what's the total cost of my plan? And then even follow that up with, okay, tell me about all the services and the value that I'm getting for all of those total costs. Mini commercial, for those who are not aware, Lasting Mark Retirement Group is, the company that we affiliated and are a massive part of. I'm very, very proud here. So given a mini commercial, and we're not alone on how we do this, but we are a retirement advisor firm. So what does that mean? Is that our fee is a flat rate fee that's tailored towards services and value in the planning that's being put in place. It's never based off of the size of the actual portfolio itself. We still want to grow it, right? But when you do better, we want you to do better.
Right.
That's our approach. And the value then is in the services and what we're truly bringing and delivering and executing for that retiree. Okay? Now, there's the do-it-yourselfer that's out there. And if you're listening to this, there's some great value in that. You might say, "Hey, I don't want to pay those fees," and gosh, we've helped a lot of do-it-yourselfers over the year. And reason for that is the do-it-yourselfer approach. It's a little bit easier in those working years, right? But as you get near in retirement, that's a little more complicated, right, Jay?
It is, because there are things beyond just what this fee structure is. We believe that a great retirement plan has a 6-pillar stool, if you will, that it sits on. And fees are just one of those 6 legs. So we have to worry about income and taxes and what a market safe plan looks like, and what does it look like with asset protection and estate planning and healthcare and long-term care. All these different things that go into retirement. It's just not about accumulation. Now we're into a distribution world as well. And so the distribution isn't just what we need, but where are those funds being distributed in total? That's part of the equation. So we can see with more clarity what that looks like. So when we put our head on our pillow at night, we have peace.
Yeah, that 20, 30, 40 something, maybe even early 50 something, right? You're putting money away and preparing for retirement. Yeah, certainly there's a path maybe to be able to do some of those things on your own.
Right.
But as then you make that crossover to being close to or into retirement, things just are a little bit more complicated. There's a lot that goes on to that point, taxes and all those different
We don't know
pieces.
what we don't know.
Yeah.
And so that's where, again, to the point of a mini commercial, I think that's where our firm and others like us, but our firm in particular, helps people know what they don't know, and we can shine light on those dark spots in retirement.
So these questions that I was prodding people to ask, I can envision as you start talking about fees, you might be out there with like a pitchfork and ready to go storm the castle of your financial advisor. But you may also be someone who's, hey, these aren't things I feel real comfortable asking, but they're important to me, and I just want clarity in knowing what those fees look like. This is a complimentary analysis that we provide as part of the On Track Retirement Review. It is one of those important pillars. And so first and foremost, you got to understand where those fees and costs are. If you've never received great clarity to that, our advising team would love the opportunity to be able to connect with you, sit down, whether that's through a Zoom or in person, and walk through a lot of these things that we talk about each and every week, specifically give you an analysis on where those fees are, not just the advisor fees, but what are those expenses and costs, and what do those look like? I envision, you go to a clothing store and you grab a shirt and there's no tag on it. A lot of times now on the walls, there's those little things, those scanners that you can go to, and those prices. That's what people need, Jay, when it comes to retirement. They need a little scanner to know, hey, what do those fees and costs look like, so they can be mindful of it, right?
Absolutely. And not only just the AUMs or the assets under management, that advisor fee, if you will, but then those internal transparency fees or internal transfer fees, internal fund fees, lots of different names to them that we can look at, mutual fund fees, if you will, as well. But then there's another one that kind of sneaks up on people that they don't know, and that's commissions.
Yeah. And there's, as you think about commissionable investment products, that can happen in one of two ways, right? There are investments that pay commissions to the advisor, and those come directly out of your investment. So I'll go back to mutual funds as an example. So as you look next to some mutual funds, it'll have the letter A or B or C, A, B, or
those
C.
are the best, right? A is the best.
Yeah, that's what a lot of people think, right? They think that, hey, that must be the rating of my fund, and I look at my statement, I see American funds, blah blah blah, and it says an A next to it. Well, that has nothing to do with the rating. That A means that it is a front-loaded commission fund. So if you put $100,000 into that A share mutual fund, that could be a 4 or 5 or 6% commission, meaning that instead of making a $100,000 investment, you've now made a $94,000 investment because your first $6,000 went directly to the advisor.
Right.
And oh, by the way, then there's fees and costs that happen behind that. I mean, can you imagine being at the starting line and all of a sudden you're going five? I mean, it's the 5-yard penalty, right? I'm switching sports analogies here, but all of a sudden, I mean, that's really what happens. You're now starting behind, the line of scrimmage when you have those types of upfront commissions, variable annuities, high fees, high cost. I'm an Ohio State guy, Jay, so I'm a Buckeye. So hear me out on this. I wouldn't even recommend a Michigan fan have a variable annuity. So with the fees and costs that are associated with those. Now, there are annuity strategies out there that don't have the fees and costs that are paid by the client. Those may be paid by the insurance company or the carrier, but that does not reduce that person's immediate principal, nor does that negate or reduce on an annual basis their returns. I like those strategies. Wouldn't you rather the carriers pay those as 100%. Opposed to the individual investor making those concessions, right?
Yeah, and I don't think that the consumers are overly concerned. They know that we have power bills to pay and we have car payments and those things that just go through life that we need to pay attention to. So it's not necessarily that, but it's where is it coming from and how much is it in the process and what's my own personal value and expense ratio that I have to figure out that looks as well. When we start out, for using that example of that A fund, and we are starting the investment train there or the investment track, that we are needing a running start just to get to zero again, just to get to zero. So I just... That dinosaur, I like fair. Life isn't fair. I get that in certain situations, but if we do have that opportunity to be fair and put that into an individual's back pocket, know as best I know I'm going to be fair. I want to be completely transparent. I want to be completely vulnerable in explaining what this looks like. So we have answers and we have questions. Let's put a situation where we have many more answers than we do questions, because questions create a level of doubt and not a level of certainty.
I love the fact that folks are listening to this and getting great education. But a lot of times, I mean, I can't tell you how many times over the years, Jay, my heart hurts because I'll sit down with somebody, maybe it's a widow, right? And maybe the husband or spouse who has passed away maybe handled most of the investments or were working with somebody. And then when they pass away, now you have the widow who was not involved in the financial planning aspect of things. And they go to somebody they think is a trusted advisor and they put them in products or investments that are high fees, high cost. And it is just, heart-wrenching when you see those. Now, the good news is those can be fixed. Right? Those things can be addressed. It's never too late to start making some changes and making some fixes. And in fact, if today is something that resonated with you, you've never had an analysis as it relates to fees or costs, or you want a complete on-track retirement picture, we'd absolutely invite you to go to myontrackretirement.com, sit down with one of our trusted, experienced retirement advisors to sit down with you and not just walk through fees and costs, but to walk alongside you, making sure that you have great preparation and great execution as it relates to your retirement. Jay, we got a great one coming up next week. We're going to be talking about the widow's tax trap. It's something that you don't want to miss. It's something that we're incredibly passionate about and want to make sure that people are mindful of some of those nasty tax traps that are out there. Thank you again for subscribing, listening, sharing. We are very blessed. Thank you for all that you are doing with these podcasts. It means a lot to us, that it's meaning a lot to you. And we look forward to seeing you again next week.
Thank you.